Hi guys, welcome to my channel, The Pursuit of Alpha. Today we're going to be talking about one of the most widely known and commonly used ratio in the financial industry, that is the PE ratio. So what is the PE ratio? The PE ratio is nothing but the price to earnings ratio for a stock. It tells us how much we are currently paying for 1 rupee earning of that particular stock. Basically, it's used to assess the relative attractiveness of a potential investment to say whether the stock is overvalued or undervalued. It was initially popularized by the legendary investor Benjamin Graham. If anyone has read the book Intelligent Investor, they would know who Benjamin Graham is. Also, the world's most famous investor currently, that is Warren Buffett, is Benjamin Graham's disciple. So, what is the formula for PE ratio? PE ratio is calculated by dividing the share price of the stock by the earnings per share of that particular stock. So how do we use this PE ratio? An example here is, let's say the share price of the stock is 200 rupees and the earnings per share of that particular stock is just 10 rupees. The PE ratio would be nothing but 200 divided by 10, which is 20 rupees for that particular stock. The general known factor is that a P ratio between 15 to 25 is what is considered as a fair value zone. However, this would differ from industry to industry. An example given here is Asian Paint's current P/E ratio somewhere around 78.32 and ITC's current P/E ratio is about 13.95. We'll come back to these two examples in the later segments. So, what is the advantage of the P/E ratio? Basically, the only simple advantage is that with a simple calculation, we can figure out what is the relative value of that stock just by looking at a small number by taking a division of the share price with its earnings per share. It also gives the shareholders an idea of how much they are exactly willing to pay for each rupee of that company's earnings. This differs across different factors and basically gives valuations to different types of companies in different industries. But what is the actual drawback of the PE ratio? Because since it's a widely used and widely known ratio, it's accepted that a higher PE ratio is generally meant as overvalued stock and people tend to shy away from investments. But let's take a look at what is the disadvantage of PE ratio. Lower PEs don't just mean cheap good companies. More often than not, the company might be heading for a downfall, which is basically reflected in the company's share price as well as its earnings. This leads to a lower P ratio. Therefore, it could set up a trap for value investors thinking that this company is actually a good investment just by looking at the PE ratio. However, the company might have suffered a setback in terms of its fundamentals, which generally means in the long run this company will not be doing well. Also, PE ratio is based on historical earnings. This takes into account what the company has done in the past and not what the company is going to do. Therefore, it does not work well for companies with exponential growth potential, as it's not taking into consideration the possible future cash flows of the company due to the expansion of the business. Therefore, for innovative companies, this is a really bad choice because since it's looking at the company's past performance, it cannot exactly tell you how well this company will be doing in the future because it's not looking at what its business or revenues could look like 10 years down the line. It's only looking at its past 12 months data. Even the forward PE ratio is not good at estimating what is the company's future earnings. Therefore, this is one of the major limitations of the PE ratio. Another thing is that the PE ratio differs from industry to industry. There is no one size that fits all. If you look at the previous two examples of Asian Paints and ITC, one is from the paint sector and one is from the FMCG sector. Therefore, their sector PEs could be really different compared to one another. Taking a look at Asian Paint's current price, it's trading at around 2,209 rupees with a PE ratio of about 78.32. That's a big number. That basically means that investors are paying 78 rupees per rupee earning of Asian Paints. However, if we just look at this number and already consider the stock is overvalued, we might not be able to get in on the potential future upside growth of this particular stock. Another key thing is that Asian Paints has always been trading at a very high valuation since the beginning. It always felt expensive. However, when it suppose was trading at 1000 rupees with P ratio of 50 to 60, if investors saw that and decided that this company is not worth investing, they would have missed on at least doubling their potential investment. Taking a look at ITC, ITC is currently trading at 174 rupees per share with a PE ratio of just 13.95. Basically, you're paying 14 rupees for per earning of ITC. If you look at the general zone, ITC does fall in the undervalued zone. However, what needs to be taken into consideration is that ITC might look attractive in terms of PE valuation, but the company is facing major headwinds due to the ESG parameters, since ITC's major revenue and profits come from the cigarette business, which is considered as a sin product. So major fund houses, mutual funds, institutional investors, foreign institutional investors are not exactly willing to put that big money behind ITC, which could cause it to jump its share price multiple fold. Therefore, just by looking at this PE ratio, we cannot take a decision as to whether ITC is a good investment opportunity or not. A closer look would have to be taken on the fundamentals and what is the company exactly doing to battle these ESG parameters. With that said, I'm going to wrap up today's video. Thank you so much for watching. If you like this video, you can share it with your friends and consider subscribing for future videos.